David emailed in before the webinar, and David wanted to know what's the difference between a monthly credit spread and a weekly. And if time decay is such a big factor, why would anyone want to stay in a credit spread trade for a month when they can get out in a week with the profits? Okay, this comes down to three main things. There's nothing wrong with trading weekly options, weekly spreads, weekly puts, naked puts, covered calls, and so forth. And there's nothing wrong with doing monthlies. Okay, will you get a better annualized return with the weekly options? In theory, yes, you should. In theory, if everything works out the way you want. However, the difference between the weekly and a monthly, now that we have 5 series of weeklies available, David, you've got a 1 week out, 2 week out, 3 week out, 4 week out, standard expiration, and then a 5 week out series. Sometimes there's 6 series available at any given time. So why would I trade a monthly when I can trade a weekly? Well, it comes down to 3 things, okay? Safety. Now, we use deltas as options investors. I prefer to look at the probability, which is related to delta, but takes more of a look at the implied volatility of the options instead of just the 50-day historical volatility of the stock, which delta is usually based off of. But in any case, right at the end of the day, right when I got your email, David, right around 4 o'clock or so, Facebook's around 195, 195.20, 195, whatever. It's around 195. The 1 week out, July 22nd, June 22nd put, my apologies, June 22nd, 190 put, has a probability of 96%. The theoretical probability the stock would stay above 190 in the next 5 days, and a 50-cent premium. Okay, but it's a high probability. Now, the 2 week out 190 put only has a probability of 89.3%. Why? Because when you go further out in time, of course, the probability gets lowered. There's more time for it to go against you. And it has a bid price of 110. I know you're asking about spreads, David, but I want to just look at the premiums here. So this is an interesting one where it is double. Normally you don't see that. Normally you'd see this one at 60 cents for the 1 week out, this one at 110, and so forth. Now, the 1 month out, and I chose July 13th, it's about 28 days. It's not the standard July expiration. But 28 days out, the 190 put only has an 81% probability of bid of 194. But the stock's at 195. I've seen Facebook move 5 points in a day, down or up. And just because it has a probability of 96%, what I'm referring to as safety actually relates to a conversation I had with a customer, a power options customer this morning. And the case there is that, he was looking at some of the naked put ideas, but they were only 2 to 3 points out of the money for a monthly and a weekly trade, where before he had seen them much further out, 4 points, 5 points. So where I'm going with this, he wasn't comfortable with those because they were too close. Even though this has a 96% probability, okay, 1 week out, we've got a 96% probability on this position for the 190 put, it's only 5 points away. Of course, these are too. But if I go 1 month out, I can get the same premium and be 15 points out of the money. Okay, so when I say safety, I'm not really referring to the probability. You can get high probabilities with 5 day out, 4 day out, 7 day out options, but you're closer to the vest, so to speak. Okay, the 96% probability 2 weeks out is the 185. You're 10 points out with a 96 probability, and guess what? You've got a bid of about 48 or 49 cents. Not too different, but you're 10 points out of the money. And then we already talked about here going to the 180 put 1 month out. You've got that high 90s probability and the same premium. Okay, so it's a measure of safety, not just what delta tells you, not just what probability tells you, but just the relation to the stock price itself. Okay. And Sam brings up a point that I'm going to get to just in a moment as well. But Sam, that's a valid point, of course, and it's all about what you select. Now, the other two things are win-loss ratio and honestly account size. Let's talk about those. Now we can pull this up in a little bit if we want to, but I looked at the numbers right after the close. In any strategy, whether you're doing bull put spreads, bear call credit spreads, David, any kind of strategy, covered calls even, you're going to have strings of winners and losers. Okay, it's inevitable. Things are going to happen that are unexpected, even with an 85, 90% probability, and you're going to take losses. Okay? Why is that important? Well, you know that you're going to receive a lower premium, a lower net credit looking at the 1 week out series in any position. Taking Facebook again, going for that safety, the 190, 187.5 spread has a credit of 23 cents. If there's other spelling errors in here, I apologize, and that's simply because I was trying to do this between 4:10 and 4:30 before the webinar started. But on a 2.5 point spread, I get a 23-cent net credit. I have a max loss of 250, which is really 227. I open 10 trades, all with the same sort of risk-reward ratio. They were making 23 cents on a risk of 227. One of those 10 trades goes against me. Some bad news comes out, something happens, and on Tuesday, the stock drops down to 185 at open, and I'm at full loss. Well, in this scenario, I'm at break even. With commissions, I'm at a loss. Right, so on 10 trades, I took in 230. On that one loss, it's 227. So essentially, we've wiped that out. Now, if I go 2 weeks out, that same spread, 190 to 187.50, with the June 29th expiration is a net credit of 40 cents. It's not double. But now, if something happens and I take a max loss, 210 on the 40 cents, well, one loss is really only wiping out 5, maybe 6 trades. Okay, so this is where the win-loss ratio, if I open a monthly spread, 190 to 187.50, I get a credit of 55 cents, and on a 250 spread, that's a maximum risk of 195. So if one spread goes against me, I've only wiped out 3 to 4 previous winners. So the weeklies with the higher probability of 85, 90 cents, this one's 23, but a lot of times you're going to see a lower net credit when you look for the higher probability. Okay? And this is where it comes down to account size. Many 1 week out spreads have the higher probability, and you might be looking at a 2 to 3 point spread. And if you're looking at a 1 point spread, you're talking about a 4, 5, or 6 cent net credit, maybe 8 cents, with an 85 to 90% probability. Okay? On a 2 to 3 point spread, you might see a net credit of 10 or 15 cents. Okay, and we've already shown that if I got 23 on the Facebook one for 1 week out, 23 cents on the 250 spread. If I look for a higher probability, and that one was high, it was at 96, but if I look for a higher probability on other less volatile positions or positions that had less premium, we're talking about 10 or 15 cents, okay? So there we see that one loss would actually wipe out almost 20 to 25 previous gains. But if you're only allocating a couple $100, and that means your maximum net credit, if you put up $400 or $500 here to do a couple of contracts, you're looking at 20 cents to maybe 60 cents, 2 or 3 contracts. And on a 2 point spread, what would that be? It'd be $400 or $900 allocated to the trade, not including the commissions you take out. $7.95, $8.95, your commissions are $10.95, you might take out half of the weekly spread. So maybe you go to a 5 point spread to get a better credit, where instead of a 20-cent net credit, you might have a 40 or 45-cent net credit on the 5 point spread 1 week out. That is still a 10 to 1 risk-reward ratio. And 2 contracts on the 5 point spread is $1,000. Why is this important, David? I don't know your account size, and I'm assuming that you're trading more than this. Sam might remember, some of you others who have been with us before on these Friday sessions might remember, end of August this year, beginning of September, a gentleman came in and said he wanted to trade weekly credit spreads with a 90% probability, but he only had about $1,000 to trade with. We quickly showed him that for what he wanted, that was not possible. Because even if he did 1 point spreads with the probability he wanted at 5 or 6 cents net credit, that's $50. His commissions at the time were $15.95. So he's putting up $1,000 or so on that trade to make only $35, $40. It's still, not a bad return. It's 0.3% for a weekly trade, but it's nowhere near what he expected. He figures he can make, someone out there said, you can make double-digit returns with weekly spreads, and you can, right? Those returns are out there, 10, 11%. But if you're trading with a smaller amount of money, 10 or 11% of $500 is not going to get you ahead very quickly. And the minute you take one loss, as we just showed before, that's going to wipe out all of your previous gains. Okay, you're looking at a 10 to 1, 11 to 1 risk-reward ratio. So those are the three things, okay? And we'll take a look at a bull put spread in a moment because I just had a question come in about that from Srinivasan. And I've got 3 questions from Bill here. Bill, I can't really, it doesn't matter if I can answer it on that way or not. Okay, let's see here. Okay, I'm just going, okay. So in any case, let me just review real quick. The 3 things it comes down to: safety, not related to probability or delta. Sure, I can find a 5-week out trade that has a 90 to 95% probability above or below from doing a bear call, but you're going to be closer to the vest 1 week out with that probability. Okay, so it's 5 points here. You might see that in a day, where your short put or your short call if you go to the 200s being threatened. All right, win-loss ratio. That's very important, I feel. When you take a look at the win-loss ratio, 23 cents off 227, there's your 10% return almost, right? It's pretty close to it for a 1 week out trade. That's fantastic, isn't it? But you take one loss from an unexpected event, you just wiped out 10 previous trades. Still, 40 cents on a risk of 210, that's pretty attractive too, don't get me wrong there. But then in that case, 2 weeks out, one loss only wipes out 5 trades. And if I get 55 cents, same strikes, going out to July 13th, 28 days, roughly 4 weeks, if I take a maximum loss, I've only wiped out 3 or 4. Okay, so the win-loss ratio is amplified when you're using weeklies. Now, our testing, we have the bull put weekly search and the bear call credit spread weekly search, and whenever someone goes to that search, they usually say, well, your criteria is looking for 8 to 14 days out in time. I want the 5-day out trades. That's fine. You can adjust the criteria any way you want to. Why is our default search looking for 2 weeks out? Because with the testing that we did, using the same stock criteria, looking for the same types of stocks over the exact same time frame, opening spreads that were 2 weeks out in time outperformed the 1 week out positions. Where over a 1-year time period of testing, I think we had an 89% return. Oh no, I'm sorry, it was higher than that. It was a 121% return using the 2 week out spreads. Forcing it to go 1 week out, we are getting lower credit, and we still have about the same win-loss ratio, but because you took the lower credit up front, more winners are being taken out. The return was only 89%. What's also interesting about this is that using the same stock criteria, the same time frame, and now that we've seen that 2 week, with our testing, we saw that 2 weeks out was better performing than 1 week out. We also saw that spreads that were 2 points apart outperformed the spreads that were 1 strike apart or 50 cents apart. And again, it's because of the win-loss ratio. A stock starts to move against you on a 50-point spread, or 50-cent spread, not a 50-point, a 50-cent spread. So I lower price stock, I sell the 89 put and buy the 88.50. I might get 5 or 6 cents, so I'm at my 10% return. But if it goes below 89, it's likely it's going to go a little bit further and go below 88.50. However, if I sold the 89 and bought the 87, I might have gotten 23 or 24 cents. So now even if it drops below 88.50 or goes to 88.50, my loss on that's only 27 cents. I just wiped out 1 previous trade, not 4. Okay, so that's what we found out with our testing there related to the spreads and the 3 points. Okay, so there's nothing wrong with doing weekly spreads. You just have to always remember proper position size. Any spread you open, the monetary allocation you're using to cover the strike price differences should not represent, or the max monetary loss you could take on the spread, should not represent more than maybe 2 to 3% of your total portfolio. So if the unexpected happens, you still have 97% of what you have. Some investors go higher to 5%. Okay, total, the bull puts credit spreads I use in my portfolio, each one only represents 3 to 4% of my portfolio, but I might have 3 or 4 open. So if I lose on all of them, it's only risking 10 to 9% of my total portfolio value, because in an unexpected event, you could wipe out 3 bull put spreads. Okay, or if there's a sudden surprise and the market shoots up, the 3 bear calls, 4 bear calls, or 5 bear calls you have might all lose. You might have just wiped out 4 months of work. Okay, so that's the important point. You've got to find the win-loss ratio that works for you. You've got to find the allocation that works best for you where you're not risking too much of your position. And you've got to find the monetary credit that works for you, and try not to get into that trap where you're getting too little of a credit trying to force weekly options with 2-point spreads, where if you take 1 loss, it might wipe out 20 previous wins, which I have seen, by the way, from other customers. And during other webinars, we've talked about that before as well. Okay, so on this topic, we've been talking about, real quick, let me do this. The second question that came in was from Vallon. And Vallon, I don't have a good answer for. I'm just going to be honest. Vallon wanted to know, do you know how soon the option price adjusts before the ex-dividend date and how to handle a current option position? Not really. Okay, usually it's priced in before the ex-dividend date. I don't know how far before. Okay, I don't know how soon or how far away. And I have no testing to really give you a good answer, and some of them are probably priced in differently than others, to be honest with you. So I just don't have the best answer there for you as well in relation to when that dividend appears. Okay. All right. So let me just scroll down here. Okay, good. So all that being said, I'm going to get to, sorry, I apologize, ladies and gentlemen. The tool is very jumpy today. All right, so while we're talking, I'm going to navigate over to power options real quick. And when I say the tool, I don't mean power options as being jumpy. I mean the GoToMeeting scrolling through the questions is very choppy today, and I'm not sure why. So let me just kind of extend this a little bit. So I'm sorry, there it is. Srinivasan says, on a bull put credit spread, the stock price should be greater than the break-even price. Yeah. The stock price should always be greater. See, when I open a bull put credit spread, my options, the put I'm selling and the put that I'm buying, are always going to be below the stock price. And I'm getting a credit up front, so the break-even is always going to be lower than the stock price. Sam had mentioned his good spread on Tesla, but I think it was actually a bear call he did. I'll have to look at that in a moment. But here's one, again, this is the weekly bull puts, and it's showing the 14 days out. And it's still kind of close, 358 on Tesla to 335. That's still a little bit close. But let's take a look at the profit and loss chart. It's a 55-cent net credit on, again, a 250 spread, 335 to 332.50. I'm selling the 335 at 430. Buying the 332.50 at 375. 55-cent net credit for a 2-week out trade, 195 risk, just similar to what we saw with the 1 month out Facebook 190, 187.5. But that was for 1 month out. Stocks at 358, your put should be out of the money. It should be below the stock price, and you're generating a credit. So your break even, 334.45, is below your short put strike price because of the credit, which should be well below the stock price. Right? I prefer to do bull put credit spreads out of the money. Okay, they have the best probability of it expiring worthless in my favor, and that's what we look for there on those as well. Okay. All right. Okay, let's see here. So we're going to get to Bill's question, and let's get to Bill's questions now. So bull puts are always out of the money. I never sell an in-the-money bull put. Why? Because if I sold the 360 put and bought the 357.50, if I'm selling an in-the-money put, I can be assigned at any time. I don't want to own 4 shares, 5 shares of Tesla, 8 shares of Tesla, depending on my monetary requirement, at $360 minus the net credit. Okay? I want to stay out of the money, and when the stock starts to drop to my short put strike price, that's when I'm going to take action to maybe roll the position, adjust the position, or get out of the position as well. But your break even should always be below. Okay, Sam made a comment which is related to Bill's question. So we don't really have a tool here to illustrate this. I should have just stayed where I was. Let me go back real quick. Okay, so if I open this spread, and let's go to 4 contracts. We saw we're generating a net credit of 55 cents for a max risk of $1.95 or $195 per contract. Now, depending on your broker, if I enter this as 4 trades, okay, now what I'd have here is a monetary requirement of $1,000, $250 times 4, but a lot of times your broker will just charge you the total requirement, including the net credit. So I might have to put up $780 on this position to make $220, still the same percentage return. Or if it's $1,000, then it's 22%, okay, on what you have to invest. So Bill's question is, I'd love to hear you speak on margin management, especially around options, since that has been a learning opportunity for me this week. Okay, now here's the trick. In this situation, if I'm using a leverage spread, credit spread, debit spread, well, the debit you pay, so you don't have to worry about that. But if I'm trading a credit spread, calendar spread, anything of that nature, or even a cash secured naked put, I always put up the full monetary requirement. I'm not going to trade a leverage spread on leveraged margin. Meaning if I have a margin account and my maximum risk is 780 or the monetary requirement is 780 because of the net credit received, and I have 50%, I'm not going to enter this trade and only have 390 up to cover that margin. No, it's too risky. Why? Because of what we saw earlier the week. And this happened to a couple of customers where they're in a bull put spread and the stock suddenly snaps down, or an iron condor, but the stock suddenly snapped down. And let's say this stock dropped to 320. Well, if you get assigned early at 335 on your short put, which means you have to buy shares of stock, your broker will likely exercise a 332.50 put to cover it. But let's say, that's a 250 spread, so it wouldn't happen, but let's say it goes right to 333. Okay? It drops down from where we are now at 358 to 333 in the morning. This put still has 12 days or so to expiration. It's at 430 now, but once it goes in the money by 2 points, this might go up to $9 per contract. I've got 4, so that's $3,600. Okay, not that, it's a fair amount. All right, so $9 per contract. If the stock dropped down to 333, still with 12 to 14 days left. I've got 4, so it's $3,600 to buy to close this put, and this one's still out of the money. Right? We're at 333, so 332.50 is out of the money. To close this put to avoid assignment, or if I get a margin call, I need $3,600. Okay, I need that money to do it. And so what I would end up doing here is closing both. If I didn't have the money in my account to buy to close it directly, and I'm risking getting a margin call because I traded a margin spread on 50% margin, which I feel is dangerous, and it is a learning lesson, just to buy this back is 5? Yeah, well, a little bit under. It's 4 to 5 times the maximum loss you expected on the position. So I'd have to close this trade together, buy to close and sell to close, and I'm probably not going to get the best prices for that. Okay, so in that case, what I'd rather do is have the money aside, and I always leave maybe 10 to 15% of my, probably 10% of my capital on hold in case I needed to manage something that went against me on a bull put quickly, or I wanted to have the money on hold to manage one of my married put positions by rolling the put up, which would cost a debit. So I always have some funds, sometimes it's 15, 18% on hold as free capital to make adjustments if necessary. I always put up the full requirement. That might not solve the problem as we saw earlier, especially your spread's a little bit wider and the implied volatility shoots up, and this goes to $13 per contract or so, which might be similar to what you saw. And then it gets really expensive to buy back 4 contracts. But this should be close, so I would always sell to close and buy to close. But if I've got the full monetary amount covering it, and I'm not using 50% margin of this monetary requirement, I don't get a call from my broker. I can stay into this position even if it fell down to 330. I can stay in this position, and again, if I'm assigned early at 335, my broker's going to exercise this one for me right away. Or I have the ability to do that, so I'm still only taking that 250 loss per contract. Okay? I have the option to do that without worrying about getting any type of margin call or concern to buy back this call or put because I've got it covered. Okay? And further on down here, oh, Sam, you had Etsy. Sam just said, I'm going through some of his. He had a good position on Etsy as well. And let's see, where was that comment? There was your bull put on Tesla is much safer. You're at 320, 325. So that was Sam's trade from earlier. Looking for that one. Okay, Sam had commented, we were talking about the spreads, whether you're using weekly, whether you're looking at volatile stocks, which you don't want to do with the weeklies because they can swing against you too quickly. You want to look for more quality stocks. When you have a spread on, you need to manage it well to cover your margin or make your spread a bulletproof trade with a 50% stop loss. So we wasn't really talking about the margin there, but you don't want to trade a margin spread on margin because those can really get you hurt as they go against you because of the cost to buy back, okay? Fernando says, to avoid a margin call, is it not better to use a bull call debit? Not necessarily. All right. Why? So in a bull call debit, it's a parity trade to a bull put credit. Okay, here we're looking at a 2-week out trade, 335, 332.50 for that good probability of being assigned 85%, or I'm sorry, good probability of expiring of higher than that. Okay. Now, in a case, Sam had Etsy, I had Goose. In a case like GOOS, if I was in a bull call debit spread where I had a short call yesterday where maybe I sold the 46 or the 47 call, okay, before earnings came out and the stock shot up, I bought the call. Okay, Fernando, so I might have sold the 47 call and bought a 45 in a bull call debit spread when the stock was trading at 45 yesterday. Okay, 44.50, somewhere around there. Now, it was 45.10, 45.20, I think. Now, the stock shoots up today. I control this. I bought that. I don't control this. What is the obligation here? The obligation of the short call is that I may be, if someone exercises it and I don't own stock, I may end up being short shares of stock. Or I may have to deliver stock and I might get the same margin call. Now, in theory, Fernando, my broker should immediately exercise the long in this case to deliver the short. But we've seen that not always be the case. I have seen situations in the past where the stock shot down on a bear call credit spread. I'm sorry, not on a bear put debit spread, and the broker assigned the short put but didn't automatically, so they assigned the short put so they were long stock, but they didn't automatically exercise the long put to get out of the position. Okay, so now I'm long stock with a put that I can get out of at any time and I can get my maximum profit, but they didn't do it automatically. So you may still get a margin call here, and if you're in a bull put and it drops between the strike prices, yes, that can happen. But if you're in a bear call and it shoots up, your call, the person who bought the 47 call assigns it early, then you might be in a situation where you have a margin call where you have to potentially cover shares of stock and your broker might not cover it by exercising the long automatically. A little bit different scenario. I agree, but it's something that could happen in that case. All right. Real quick before I get to Bill's second question, I did buy a 45 call on Goose that's up 15 points today, and I sold 2 47 calls in a married put structure. I did that yesterday before earnings. Okay? Why would any person do that? Well, because honestly, what had happened is that a lot of the stocks I've been in recently haven't had good earnings. They've had good earnings, but only moved up 3, 4, 5%. The last good earnings I had was on Ali, I think. The stock did everything right. Beat earnings, beat last quarter, raised guidance, everything was profitable. But something happened overnight where the market opened down. So in the pre-market, the stock was up 12. When the market opened, it was only up 3, and then it continued to drop, so it was only up 1% at the end of the day. But its earnings were more impressive than Goose's were, from my standpoint. Okay, but this spread that I did looks ugly now. But what it ended up doing is I had shares of stock at 39.03 and I owned an October 45 put for 6.80. So it was a 1.8% risk. This spread, and I figured the stock would only move up 5 or 6% from $45. Maybe it could go 10, but then that would only put it at 49. I bought one call at 290, 45 strike. Sold 247 calls at 205, and this was when the stock was at 45.20, 45.30. So I took in 410, paid 290, so I got a net credit of 120, which bulletproofed the position before earnings. And the max profit, if the stock was right at 47, was 915, or 20%. This trade is 45 days old, I think. So 20% in 45 days, I would have taken it. But yeah, it's slept off as you go up because the put's losing value. I didn't expect a 33% gain. It jumped up 26%, came down, and then continued to move up the rest of the day. All right, so I had to manage this position. Now, what you see here, of course, is where I'm going with this, Fernando, why it's related to this is I'm short 247 calls. One is covered by the stock. That's why it's not naked and have infinite risk. The other's covered by this long call. With this type of movement, as fast as it was, I was, even though I didn't use the 15th of June, my apologies, these were actually out to June 29th, and I went out 2 weeks to potentially avoid the case of early assignment if it suddenly gapped up, if possible, because all the action would have been on the 15th. So this is wrong. It's actually the 29th of June. But in any case, I saw what happened in the pre-market. I tried to send out an email to the Fusion subscribers letting them know that, hey, I see this happened. I'm going to adjust the position. Don't worry. But I've got to see something that I can't control. I have to see at 9:31 or 9:32 in the morning if I've already been assigned on the 47 call and then closed out a bull call debit spread. That's what this is. It's a bull call debit spread for about a 90-cent or 85-cent debit on a 2-point spread where I sold 145 and bought, I'm sorry, sold 147 and bought 145, and then the other call is just a covered call on the married put. But I figured I would have been assigned. Even with 2 weeks out, with that movement, I figured I was going to be assigned, but I wasn't. So I managed the position. But that's what I figured was going to happen. I figured I was going to wake up and I was going to be just long a put that had a value of $1.50 out to October, and everything else was called away for a profit. 47 here, so 8 points there. The other 2 points from the spread, which I still got. I essentially closed this part of the spread and closed it for a credit of about 190, I think I got, because they were so deep in the money. But then I had to adjust this, and it hurt. I had to pay $12 to buy it back and rolled it up and then moved the put up. So I'm still in a 0.4% risk position with a 55 put in place now and a max profit of about 14-15% to the upside, but I'm going to manage it more effectively. But anyway, yeah, I got caught. I should have just left it. What would I have done had I just left it open? Well, that's the comparison. The return would have been 36.3% had I left the upside open. But I hadn't seen it, and I had seen a stock actually have a 15% decline on one of my other stocks, so I was a little bit nervous about taking the risk on it, so I tried to shorten the risk, and I figured it wouldn't see more than a 8 or 10%, and every time I say that, well, it does. Sorry, long story short, but it was still manageable. But there is a possibility that I could have been assigned on the covered call, right, with my 100 shares of stock gone, and they might have assigned the other 47 call, and I might not, my broker might not have exercised the 45 to cover it. So now I might have been short shares of stock at 47 that continued from 58 up to 61 or 62. Okay, so That's the issue there. So now Bill's other question was, is there a way on power options to search for the highest theta? Yeah, in most option strategies, so I go into a search here for naked puts, Bill, for example. You can add the Greeks in, you can add the columns in, and I thought you should have theta here, but maybe you don't have theta here, but you can sort by the time value, okay, the highest percentage time value, which would in turn imply the highest theta. The more time premium you have, the more standard time value or percentage time value, the higher the theta is going to be. And of course, I believe you can filter the results by the time value and possibly the theta as well. I thought it was in here in one of the other Greeks as well. And of course, when you're on the option chain, you can choose to view the theta, the daily theta, and the others as well. So if you sort by time value, you're going to be pretty close to sorting by theta. The percentage time value, okay, is pretty close to me highest daily theta. No, that's not always the case, but it's pretty close in this situation. Yeah, if we sort it by midpoint, yeah, if you sort by the time value midpoint, that might also give you the highest theta sort just by default, okay, even though it's not there. But I'll look and see what the programmers can do with some of the thetas, but it is there. Bill says one more. Is there a best day of the week for getting into options trades, particularly covered calls? I've noticed some great shades that are only present on Friday mornings just before expiration. All of the testing that Ernie and I have done for weekly spreads, weekly positions, if that's what you're looking at, we found the best returns going Monday that week to the following week. So for the weekly covered call picks of the day we have, Bill, and the weekly naked put picks of the day, the best results in the write-up that Ernie has when we're talking about those positions. If I go to, naked put again, we go to weekly picks of the day. We update them every day at 3:30. Okay, we show what they are every day. But when you click the link here that says see how we develop these results, whether you're looking at the weekly or monthly covered calls, or the weekly or monthly naked puts, we go through a description of what it was, what was the testing goals. We have updated testing periods as well. This is just the first one. And the testing conditions, the Monday at 3 p.m. were used each week. Why? Because once Ernie found the best results based on what he thought he would see by opening positions on Friday or on Monday, okay, Friday the week before, so a 7-day trade, or Monday where it's a 5-day trade, when he got the highest results between the two, he kept testing, and just the 4-day, 5-day out trades outperform the ones for 7 days when you open Friday, because the more positions you open at the start of the weekend and leave open, the more chance you have that on Monday the market's open completely different. Something happened over the weekend, a lot of positions were hurt, where if you wait till Monday and the market opens down and then settles, then you open the positions with only 4 days left, it performed better in both situations, covered calls using weeklies and naked puts. He also tested it opening the same types of stocks with a similar premium for 3-day trades opening on Wednesday or Thursday, and still found the Monday outperformed. Okay, so I don't know if your criteria works the same way in that explanation, but that's what we have found. So for the testing that we do, the strategies that I do when I'm using weeklies, whether it's the bull puts or if I'm talking about the weekly picks of the day for naked puts or covered calls, I'm opening the Monday 4 or 5 days away before the Friday expiration. And with my bull puts, of course, they are 14 days out, but I'm still opening them on Monday, not on Friday, to open a new position before the weekend goes through. Okay, and the 1-day and 2-day trades, you might find good covered call positions for 1-day and 2-day trades. And I did have a customer mention this to me the other day. Let's see, let's go back to weekly picks of the day. Now here's a high drop. Yeah, see, this is one we were talking about where it's a little bit close to the vest for the weekly, but it's showing a 4% yield. I'd probably go to the 37 put here and I could still get a 1% yield. That would make me feel more comfortable in this position. But in any case, okay, where I'm going with this for something as DBX, someone might say that, oh, okay, yesterday I could have opened a position and had a 0.4% return for 1 day. All right, that's fantastic. And they say, well, if I trade the 5-day out, it's only a 1% yield. So if I get 0.4% every 5 days, That's a 20% or a 2% return, and I'm doubling what I'm getting on the weekly spread. On the weekly. Well, here's the problem. If I traded a position yesterday that expired today because the time value went to 0 and the option expired, and I made my 0.3 or 0.4%, which is great for a one-day trade, don't get me wrong. But I can't open a trade today, hold it over the weekend, and on Monday close it for a 0.4% gain unless the stock really moves up. If it stays the same, it's still going to have 80% of the time value that I originally sold it for. And if I open a position on Monday, I'm not going to be able to close it on Tuesday for a 0.4% gain unless the stock really takes off. It's a normal trading market. I'm not seeing that decay. I'm seeing 0.3 cents per day on Theta, as you mentioned, 0.03 cents is what I meant to say, or 0.08 cents, less than a cent, until I get to those last 2 days. So the idea of making 0.4% per day and saying that that can outperform opening the 5-day out trade or 7-day out trade is not realistic, because that's only 0.4% because the time value decayed because the stock did what you want. You won't really be getting that every day unless you continually pick stocks where I'm selling a naked put, for example, and the stock moves up 2 or 3% each day, so I get 0.4% of what I expected to make by Friday. Very difficult to do that unless the stocks are really moving. And a lot of stocks have been really moving. But that's the idea. I understand the allure of it, the idea of it, of having a shorter time frame, entering in a one-day trade or a two-day trade, and looking for the best time decay. But remember, time decay, this is part of another conversation I had with a customer today. Actually, I can't remember the stock we were looking at, but it was a stock that was out till next week's expiration. And he was looking at it today, 7 days away, I'm sorry, and the price was about 40 cents. Where are my notes? Hold on, you're going to hear some paper rustling here. I'm going to look back on my notes, see if I wrote it down during my previous discussion. It wasn't that stock. I got about 6 stocks written down from the 7 conversations I've had today with customers, and I don't have that particular one I discussed. Okay, so let me take a look at something here. Try FDX. I'm just going to take a look at a quick chain. This has earnings coming up. We're going to look at out of the money put for next week. Oh, sorry folks, here we go. Okay, so high price stock, let's look at the 260, and let's call the midpoint or the time value 335 roughly. Okay, now, I had it here earlier. All right, hold on one second, let me just add the theta in. Okay, so I'm sorry, I clicked see more or less columns, so I'm going to click on the daily theta there to add it. Okay, I'm going to resend that in. Now I should have theta. So I'm sorry, I'm looking at the 260, 335, and my theta is 12 cents for 7 days. That doesn't make a lot of sense, does it? If I only lose 12 cents per day over the next 7 days, right, that's 84 cents. Okay, so how is that possible? If everything remains the same, volatility, the stock price, how am I going to lose 335 with a daily theta of 12 cents? Well, it's because the theta curve works exactly as the time decay curve. When you're talking about options that are 5 months out versus 30, I want to be buying out here at 150 days, and then here's 120 days out in time. Okay, here's blah, 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 90, I'm sorry folks, and then here's 60, 45, and then it really pans off on the last 30 days, and the last 10 days it essentially just goes like that, okay? Comparatively, so 150 days out versus 15 to 20 days out. That's the time decay curve of an option. And the same is true with a weekly, right? So we see a curve looks like this. This is 2 days out. This is 3 days out. This is 4 days out. This is 5. This is 6, and this is 7. So what happens here is if volatility and the stock price remain the same, I lose 12 cents here. The theta is probably going to go up to 20. Then it might go up to 40. And it's still, if this 260 is still priced at $1 here, we might see this theta go up to $1, $1.10, because it's going to lose the most in the last 2 days. And that's why you see some opportunity to say, hey, why is this still inflated? It's the same reason that I sold a call 2 days ago on Ollie for today's expiration. The Ollie's bargain brands. I'm in a married put. Stock's at 74.50, 74.40, and I could sell the 2-day out option for 60 cents. I figure, what do I have to lose? Okay, so I sold it. Yesterday it goes up to 75.40, so I'm a little bit annoyed, but then I wait. And then today, Ollie opens at 75.18, 75.20, and then drops down. But when it was at 75 even, okay, 5 hours to expiration. So we're roughly at about 11 o'clock, I think. Stock was at 75 even. The bid was 26 cents on an option that expires in 5 hours that's right at the money, and the ask was 60. He wanted me to pay 46 cents for 4 or 5 hours of time premium to buy that back. I had just sold it the day before at 60 when it was out of the money. Okay, but now he wants me to pay 2/3 of that to close it when it's just about expiring worthless. So I waited, and the stock was even down to 74.80 with 2 hours to go. The midpoint was still 36 cents. That's what you're playing. You're playing selling it on that day. You would have sold it this morning when it was around 40 and just waited for it to decay. Now, the option would have expired worthless, but I didn't want to take the chance, and I didn't want to have to spend the last half hour of the market watching Ollie to make sure that it comes down in price, okay? So I closed it for 10 cents. I got sold it for 60 on Wednesday, bought it back for 10 cents today, made 50 cents in 2 days. I'm happy. But Ollie only offers monthly options, so guess what? I can't do that next week. I can't sell it on Wednesday for 50 cents and buy it back for 10 cents because I've got to sell the monthly July 75 for about $1.10. And guess what? By next Friday, if it's still around 75, that's still going to be worth $1.10, $1.05. Okay, it's not going to lose that time value until I get into the last 5 to 7 days in that position. Okay, so we got a different Sam. This is Sam H. The next question that came in is from Sam H. And before I get to you, Sam, I will promise I'll get to that right away. I just wanted to check 2 things. Sam just mentioned here the similar trade that we talked about a moment ago on Twitter. Rolled his calls to 50 and paid a debit of $3. Okay, that's there. All right, and then let's see. I'm just scrolling through some things here very quick. Sam H. Okay. Oh, and Bill, don't apologize for the questions. I just want to make sure. So Bill's last comment that came in, he says, sorry for all the questions. Please don't let me hog your time. No, it's no problem. They were all different questions. One more comment on this. Bill said, speaking of theta curve, he's been having good luck with power options and calendar spreads. And I like calendar spreads too. Says on power options, I found KBH, bought the January 30 at 515 and sold the July 23 puts. Oh, calendar put, 23 puts at 34, okay? Looks like a good position right now. Might get a $7 profit if it gets assigned. Good. Yeah, so that's on KBR, bearish calendar put spread. And one of the best ways to mitigate theta is the diagonal spread. So I buy that option that's forward in time that has a slower decay, and I sell against it week by week or every 2 weeks to get the rapid theta decay when I'm losing less out in time. And again, as we've talked before, in addition to the bull put spreads being with 10% of my portfolio, calendar spreads, diagonal spreads are also. All right, so Sam is at BIDU, currently at 272.97. This is Sam H. Sold the 22 June 260 and okay, you might need to clarify this for me. You said you sold the June 22 260 call and sold the 261.50 call for 40 cents. Okay, so you don't have any long calls here. You're trading naked calls, am I correct? 260 deep, 260. I guess you meant 262.50. There is no 261.50. Okay, so I'm not sure if you're in a bear call spread here where you got a 40-cent net credit. Maybe that's what you meant. You sold the 260 and bought the 261 or 262.50. Okay, so let me try this. This is what I think you did. Let me look real quick if this is at 272.97. Okay, so you might have done this back here and then it's just been moving up. So you probably did it within the last 10 days, 20 days or so, and now it's just been moving up against you. This is what I think you have, Sam. Correct me if I'm wrong. You're in a bear call spread. Let me go back to my profit and loss chart for you. You're in a bear call spread that's now moved against you and is at full loss. Okay. One moment, ladies and gentlemen. Yep, so you bought the 26,250, got a 40-cent net credit. Okay. These types of positions are very difficult to manage. Okay, we have a full webinar. I'll show you where to find it in a minute, where we talk about the 7 ways to manage a bear call spread. And we talked a little bit about that last week. 7 ways to manage a bear call spread. If I'm in a bear call and the stock starts to approach my short call strike price, the threatened zone, you know, option number 1 would be just close the position, take the loss, and try to make it back in other trades, not necessarily BIDU. Okay, so close and take the loss. Not attractive, but sometimes, especially when you're already near max loss, trying to do magical management techniques, turn things into broken wing butterflies might get you into more trouble than where you are now. All right, number 2 is roll the spread up. But here's the situation. You took in a 40-cent net credit, so you have a 210 risk. You liquidate it now, you're pretty much close to the full loss of 250, so you'll have a loss of 210 total. Now, if you say, well, I need to roll, I'm going to close this current spread, but I'm going to roll it up and out to repair the position. A lot of investors talk about that. You just close these legs and they say, hey, I'm going to create a new spread here with maybe the 275, 277 and a half, and you know, I'll get a credit for this position in that case. Okay, let me jot that down for you very quickly, Sam. 272.50 to 270. I'm sorry, 275. I apologize. 270, and that's not even a great probability, but 275 to 277.50. Okay, but here's the thing. You're not going to find a credit of 210 next week by selling the 275 and buying the 277.50. Okay, you're not going to find a credit of 210 going out to July. You might have to go out to September to see that kind of credit. Okay, that, in other words, if you just roll up and out right now, you're probably still at a loss. It's going to be less of a loss. You're going to move this up, but you're not going to be at a profit. So once you've hit the full loss, it's harder to just roll the spread out unless you go 3 months, 4 months out in time. But I've jotted that down. I'm going to look at it in just a moment. Number 3, doesn't work. A lot of times say, well, if the bear call is getting threatened, you can create an iron condor. And these are sort of out of order, as you might see in other webinars, I sometimes forget. So we could do an iron condor. Well, this is too far gone. That's only if it's near here and you think it's going to stabilize or maybe pull back. You sell a bull put to give you a little bit more cushion to the upside. A 4th one is close and do the opposite. That might be okay. We close from number 1, but let's be honest. The risk with number 2, even if you could find a profitable bear call spread 4 months out, is so far you've picked the wrong direction. Don't be offended by that. I do it all the time. But you've picked the wrong direction. This stock is going this way. Simply moving to a new bear call further out in time means you could lose on the next bear call and the next one. Use whatever cliche you want. Stand in front of the train. Try to catch the falling knife. Okay, it's going the wrong direction for the strategy you're in. So close and do the opposite. You might be able to open a bull put spread with a 270 to 267.5, or maybe the 267.5 to 265, but in a bull put spread. But again, to make back that 210, you're talking about going 4 months out in time. Okay, so the iron condor isn't going to help you. This might, but you're going to have to go out 4 months. Rolling it up might do that. It'd be expensive and it's going to hurt. Number 5, very seldomly used, and you only have 7 days left, but it would be just buy to close the short and leave the long open. So I close the short, and now I'm left with a long call position. This would have worked for you had you done it when the stock was just above 262.50. I'm sorry, just above 260, maybe at 261, or when it was at 259. It would have cost you a ton of money to buy this back. But if you could see that it was continuing to go up, your 262.50 call is now worth at least $15. The loss you took here, 5, 6, 10 days later, you would have had a successful trade. But we're beyond that point. Unless BIDU in the next 7 days, next week, goes up to 290, because you're already paying probably $15 to buy to close this call, the 260, and you might get $12.50 for this one. There's your $250 loss. But if it continues, if I close this for 15, as I mentioned, the stock goes to 290, your 262.50, you know, it'd be worth $28. I don't want you to, I'm not saying you should do that now because it's already gone the point. Number 6 is the pendulum adjustment. I don't think that's going to work. In the pendulum adjustment, what I would do is sell to close the 262.50, swing it down, and buy a 257.50. So in one move, without opening a new spread, without closing existing, I've just rolled down the long call to create a bull call debit spread that's now deep in the money. In order for this to work, the net credit you originally received minus the buyback cost, I'm sorry, yeah, the net credit you received plus what you get for selling the long call right now has to be greater than what you're paying for the new long call minus the difference in strike prices. It's confusing, but it has to be. So number 6 is the pendulum. I don't think it's going to work because we're so deep in the money. The pendulum works when you're in between the strike prices, but let's take a look. What would a pendulum be in this case? As I mentioned, the 262.50 is my long. I'm not going to adjust the short. The short's staying where it is. But I'm just going to roll with one commission the long. So the 22 June, I'm going to buy to close the 262.50, sell to close the 262.50 for around 11.50, and buy a 257.50 for 16. Oh, so close. It really is. So 262.50 we sell, 257.50 we buy. Why would I do this? Well, now I've got a bull call debit spread, but at $160 loss, which is probably close to where you are now if you liquidated the position, right? Because it was a 250 spread, you got 40 cents, it's 210, but there's still time value. So this doesn't do much for you in this case because both of these options are really close to intrinsic value, so it's not giving you any benefit. That's why it works when it's between the strike prices, not when you're already this deep in the money on the spread. So you could, you know, those are the 6 ways. There's other ways too to manage this particular position, a 7th way, but I don't think they're going to work. You know, trying to do anything magic to convert it to a butterfly or anything of that nature. Oh, someone says, why don't you adjust the short call and move it up? Well, it's because that doesn't work. If I try to create a bull call debit spread by buying to close this option and then moving it up, it's probably going to have the same result as we just saw. Usually we don't do that. But we can look at it. So now in this case, remember, I already resold the 260 call. So I have to buy it back now for that $14, $15. I'm going to buy it to open the short. And let's move higher. Let's move to the 267.50, but I'm only getting 760 back. Okay? So we buy the 260, leave the 262.5 where it is. I'm going to sell a 267. So you're rolling the short one in this case. And see, that's a little less. It's not actually that bad, but you had to go 2 points higher. Right? You had to go to the 267.50. So this gives you less of a loss, but you're not going to get a gain because they're so close to intrinsic value. Okay? Follow-up from Bill. When you're unable to trade for a few days, which might have you know, been the situation where it got away from us here in this case on this spread, you know, if there's an emergency, illness, or in my case, jury duty, do you close out your trades or just certain types until you get back? Well, 50% of my portfolio is in the married put positions. Okay, so I'm not worried about those. I'm okay if I'm going for 5 to 6 days because all of them have less than a 3 or 4% risk. I will typically close or liquidate my bull put spreads, but remember, I'm opening my bull put spreads almost every other Monday. So if I know something's coming up in the next couple of days, say a Tuesday or Wednesday of the week, I might just not open any spreads at that time. In my diagonals, I don't know if I would close those because they are longer term, but they are leverage. So in that case, Bill, what I might do is I might buy puts on SP. If I'm in calendar calls, I might buy puts on SPY or calls on the VIX if I know I'm going to be gone for a week or two. And if I'm in calendar put spreads, which are bearish, I might buy calls on SPY or buy puts on the VIX as a hedge. The safest thing to do is anything that's a leverage trade where you could take 100% loss if you're not watching it is to close it. That's the most conservative thing. Any long calls that you have that you haven't locked in a gain or don't have a gain for you now that could lose 100%, close it and maybe come back later. Might you miss a run like Goose or Etsy because of earnings? Well, sure. Another thing you could do if you have long calls is buy a put to protect it, and so forth. And so that might be a relationship that you might want to look for. Okay, so I think I have to get to, oh, Sam made a comment. I'm sorry, Sam just put in a comment here. When we were talking about David, when we were talking about the credit spreads earlier, the weekly spreads, okay, Sam suggests you might want to consider doing it in SPY because you have 3 expirations. And that's true. That's something I don't usually mention. I always forget because as an options instructor, it bothers me immensely. So now I have to answer to everyone, why do you see a Monday, Wednesday, and Friday series on SPY and SPX? Yeah, they have 3 days now. So in my discussion about how you can't get 0.4% every 3 days because you can't, if you open on Thursday, close it on Friday, well, you could open on Friday now and close on Monday. And then you could open on Tuesday and close on Wednesday. I don't know if you're going to get 0.4%, depends on the movement of the option or the underlying stock. But SPY is a good point by Sam. I always forget that because I don't like talking about it. It annoys me because I have to go through the chains and make sure the data is correct and everything and how we're sorting through it. The programmers do most of that work, but I have to verify what's there. Terrible. Anyway, but that is a good point for David's question at the beginning, is that SPY does offer Monday, Wednesday, and Friday series. And Sam, if you're trading them, or if anyone decides to trade them, be careful in 2 weeks. It gets weird because 4th of July is a holiday and it falls on Wednesday this year and the market's closed on Wednesday. So that week there's an expiration on Monday the 2nd for SPY and SPX, Tuesday the 3rd, and Friday the 6th. They moved it up one day. So there's a Monday, Tuesday, Friday series of that week, not a Monday, Wednesday, Friday because the market's closed for the holiday on Wednesday the 4th. Oy. That's all I'm going to say about that is oy. All right. We do have a couple of questions. Another question from Fernando. Rajiv has been patient, and I've got a bevy of questions, and I think they're all related that have come in from Rajiv. Okay. Okay. All right. So I'm going to try to do this as best I can. Around 3 weeks back, I created a diagonal spread on Disney and Pepsi. Both options are in the money. When you started, both were out of the money. Okay. Will I leave those positions or push the short position to long call weekly? Last week we discussed Ford. Yeah, I was expecting around 1250, but it was down. Okay, so it went down to 1190 from 1210. And you can wait to move it. Chart still looks strong. Okay, so in my opinion, in a diagonal spread, if you're further out, okay, Disney or the long, the 102 July, and short the 6th July 105. Okay. I guess Disney moved up because they got outbid, maybe. Long July 102, July 6. Okay. I'm thinking you mean standard here. Oh, you don't? Okay. Long 102, July 6th. You didn't say which July, so I'm going to go short based on our previous conversations. 105. Okay. Debit cost of around 130. All right. So we're buying here and selling here. Don't know the prices yet. Oh, that's close. No, it's 244. I'm sorry, that's a 244 debit. So let's drop this by $1. Check cost by $1 and put this up by 20 cents. Oh, you said 130. Okay. Drop that down by 10 cents. Close enough, 135. All right. If this is kind of your structure, I'm okay with this. I mean, if you could get assigned here, this doesn't tail off like I've seen other positions, okay? If it starts to tail off here and you enter a loss zone because it's moving up, that's a concern. This still looks good. I think your best case might be to let it get assigned if you don't pay the money to roll it. First thought is, I don't know if you have the July 13th. I just plugged that in there based on the discussion we had when you're 1 week apart on your other spread. So in this case, it doesn't look bad if it keeps going up. Could you roll it? Sure, but I think to get any benefit, you'd have to move from the 105, excuse me, for July 6th to make this a vertical spread, 102, 108, for example, for the 13th of July. I don't think rolling in the same week is going to give you the outcome you want or increase your return by too much. This did exactly what you wanted to. Be happy. Don't be greedy. That's all I'm really going to say about that. Could you roll it up? Sure, but I think the only way it's going to work for you to increase this any more beyond what you really have is you'd have to roll that near-term July 6th out to July 13th. We'd have a vertical bull call debit spread at 108 with the 105. I wouldn't try to do anything more creative than that. You know, I wouldn't try to do any kind of double diagonal or try to do any kind of ratio on top of this or anything along those lines, all right? And same, I guess, would be this, I'd say, for Pepsi, too. Looks like it went in the direction that you want, and you've got that profit there also, okay? Okay, hold on. And you've got a calendar in Delta as well where you've got the 57 and July 13th for earnings. Okay, well, you might want to add a put to protect it. I guess you're in a straight calendar there, aren't you? Your straight calendar, I think, is the July 6th to July 13th again on that one. It's just D. Let's see. Oh, no. What is Delta? DA? Ah, damn it. Darn it. I always forget Delta. I knew it before. DAL. Long week, my friends. Long week. All right. July 6th and then July 13th, did you say? 57s. Okay, so this one, if that's the case, it's not doing what you want. You're at the 57 strikes for both, I guess. You didn't give me a strike on the other one. But this is the earnings week for 255, you said. On this position, sell by. Okay, if this is the spread you're looking at, I'm not too worried about it now. You've still got time for it to move the way you want. I think you're hoping that this one expires before the earnings date, and then you can have the long call at a cheaper price. So I don't know if I'd manage this in any direction right now. You're still waiting for the next 12 to 14 days to get it more up to this point because you're still kind of bullish, but it's dropped recently. But I don't think that's too bad there. Okay, Bill had another follow-up here. He says, when you have a short call put, how often should you roll to capture earned profit? I've been having a lot of debate about this with customers, and I've been, I haven't been as diligent as I would have liked this week with getting into certain topics. I'm working on about 6 webinars right now that are for weekly free webinars, and I'm also working on 4 larger projects for Blueprint owners and Fusion members. So I've got about 10 things going in addition to what I'm doing during the day. Just, you know, what everyone says, get one done at a day, one done at a time, and that's what we're doing. But anyway, the question comes in is how often should you roll the short calls or the short put on that position to lock in a profit? I'm also getting the question that comes in. It says, how often or should I close all of my credit spreads when I get a 50% profit, 50% of what I expect to make? Someone out there on the internet And there's validity, it's a very conservative approach to it, but it comes with a risk, believe it or not, okay? Someone out there is saying that you should close credit spreads when you have 50% of the expected profit. So on a 5-point spread, if I got $1 net credit on the position, if at any time the debit to close the spread, buy to close the short put, sell to close the long put, is 50 cents, and I can make 50% of what I expected to make, I should go ahead and do that. And the idea is that if you're usually right 85 to 89% of the time, then you can actually be right 93 to 94% of the time, and you'll increase your gains, okay? And that's kind of the idea, but it doesn't always work that way. Let's talk about a credit spread. Let's talk about a 2-week out credit spread where I'm making 23 cents off of a risk spread of 250, as we saw earlier in the webinar on Facebook for the 1-week out trade. Well, really, that's 23 cents by 227, which is pretty close to making 50 cents on a 5-cent spread, which works out to be an 11% return, right? Because your real risk is 450, so it comes out to be an 11.1% return. And I would never try, we're going to manage spreads, but if I do take a loss, I'm going to try to keep it under 50%. So this tool here that we show in radioactive trading, what it's doing is going to flip a coin 100 times, okay? And what I'm going to do here is say that when I'm right, we're going to make 11.1%, 25 cents off a 250 spread, 5 points off of a 5-point spread, 10 cents off of a 1-point spread. It comes out to be an 11% return when you know the real risk is only 90 cents on the 1-point spread, 225 on the 250-point spread, and 450 on the 5-point spread. So it comes out to be an 11% return. I'm going to have losses, but I'm not going to let them go to 100. I'm going to manage them, so even if I do have a mistake and I take 100% loss on one of my credit spreads, it's going to be balanced out because some of the other ones I'm only going to take a 20. So my average is only going to be 50% loss of what I invest. And probability of loss is only 20%, meaning 80% probability of success. I'm going to start off with a portfolio of $10,000, but I'm only going to allocate $2,500 into each trade, 1 quarter. Okay, that's really high, but let's say I was in a $100,000 portfolio. I'm really only allocating $10,000 of that $100,000 to these spread trades, and I'm only 25%, I'm sorry. I'm only allocating $2,500 into each trade, so that if one goes against me, I still have 75% of what I started with to allocate spreads. Now I'm just going to run the scenario. Interesting, isn't it? 80-20 in this case, being right 80% of the time after strings of winners and losers, I'm still at a loss. Okay, I need to, if I'm looking for 80% probability spreads, you actually need to be right 85% of the time. Oh, I'm sorry, that changed. Sorry, it went 50. Okay, here we go. Okay, so there's 83. We're closer to a profit. 79, 83. All right, so this is what we have to do. So this is why my bull put spreads, by the way, on the weeklies are looking for an 85% probability or higher. We're going to lower that. Oh, I'm sorry, folks. That's my problem. It's my mouse. It keeps clicking in those boxes and not clicking out. Okay, so here's 82. Anyway, what I'm getting at, there we go, 86%, right above the threshold. 50% return after 100 trades with a drawdown of only 5% or so. That's what I'm looking for. That's an 85% probability, looking for about an 11% return or 20 cents on a 2 or 2.5 point spread. Okay? Now, what happens when you change the dynamic and you close out the spread positions for 50% of what you expected to make? Not all of them, okay? But let's say some of them. And some of them you still take to the full 11. Well, instead of taking now, if I close out half, that means I'm only taking a 5.5. So let's say now my gain is lowered. My average gain is lowered to 7.5. But guess what? You're still going to lose. And some of them are still going to hit the 100% loss. Some of them you'll still manage for only 20 or 30% loss of the maximum loss, but your average is still probably going to be 50%. But your idea now is that you're going to take this to an 89 or 90% win ratio because you're closing more early. And you're a little profitable. Okay, that's good. That's 40%. Here's doubling. That's great. But if you close all of the winning spreads out and cut your win-loss ratio down to 5.5%, still risking 50%, 91% winners only gives you 4% return. Okay? 87%, you've lost half. It's a trade-off. It sounds conservative, but you have to make sure that you're hitting the numbers. You need to be 94, 95% win rate. If you cut all of your current returns in half that you were expecting, around 10%. Oh, here's actually, this one's a little bit better. 92%, you're at a 20% return, but you did go down to 34% loss at one point. And this is how the margin works against us. 98, there you go. 98. Now, what does closing your winning positions by half of the return do for you? It limits the upside of higher returns that you might have had if you're closing early. You might not defeat the losers in this case, all right? Because the ones that lose go against you so quickly, they're still going to happen. The Sam says it depends on stock performance. You're absolutely right. But the spreads, the one we looked at today, earlier, that we saw in that trade where it had moved up above both strike prices on that bear call. When something happens suddenly and it happens overnight, that was kind of the case there. There were a couple overnight jumps that really got that spread into trouble. That might not have been the one you could have closed for a 50% gain before it hit the loss. It happened suddenly and unexpectedly, and guess what? You still took 40, 30, 50, 60%, or 100% loss on that trade. You're still taking an average of 50% loss. You're not negating those. What you're negating by closing early is the positions that showed a profit but then maybe pulled back to where it would have been the 10 or 15% loss. The ones that go against you for the full loss unexpectedly in this strategy, closing out at 50% is not negating that. All right? It's not negating those surprise ones. It's negating the ones that had the smaller loss, where in fact, I have to do this for the presentation. I have to go through just an open look at 10 to 12 credit spreads per month over the last 6 months and say, which ones would have been closed for a 5-point? Here's what it would have done had I done nothing. Just let them go to expiration and done nothing. Here's what it would have done if I closed it at half. But I bet you the ones that I lose on that hurt the portfolio the first time are still going to be in there, because it was a surprise that happened when I probably wasn't near the 50-cent profit that I expected. So by that rule of thumb, long story short, but it's just an extra edition of what we like to talk about here on the spreads, and we have discussed this briefly past couple of weeks and with other customers here. To answer the question about when to close a short call and short puts, Ernie and I strongly believe that if you've made 80% of what you expected to make on the naked call or the naked put or on the credit spread, then you want to close it. You won't affect the upper end of your return, your expected return, by too much. You'll still keep the same win-loss ratio. So if I'm still around that 85, and let's say I lowered it just down to 10 from 11.1, I'm still in profitable range. 88%. Don't need to be at 93% winners, 94%. And as I mentioned, there's no guarantee that closing the winners early will prevent the 10 or 15 out of 100 trades that just drop suddenly out of nowhere from something you couldn't see on a chart or the news or anything and result in the 100% losses on the trade. Okay. Yeah, Rajiv, real quick, just map it out. You said on Pepsi you're planning to move the 105 short call to the 110. Is this okay? Sure. Just map it out first and make sure the graph that you see matches your risk-reward tolerance of what you want to see in the position. Okay? All right. So let's go back to the chain. Did I have a chain up here? Let's just go to Ollie real quick. Do I have it on the call chain? Real quick. This is just for... I don't think I have it here. It must have been on my puts. Okay. Oh, it was in the other one. Okay, it was on the search. It was on the naked put search, I believe, in any case. But let me just do this real quick. So I'm going to add another column in real quick. I'm going to add them all in. Yeah. Okay, so the question here that comes in from Fernando is, why does the value of gamma of an at-the-money option increase as we go towards expiry? Okay, so remember, everything is an effect of everything else. In theory, the gamma is the rate at which the delta changes as the price of the underlying security moves to 1 point. Okay, and we see here the deltas of the at-the-money. I'm sorry, we're looking at Ollie at 75.10. Oh, it did close above 75. I made a good call closing at 10 cents this afternoon. I had the short June 75 call. I sold for 60. Look, here at the end, bid of 0, ask of 45 is forcing a 25 cent buyback with a stock at 75.10. So I'm glad I bought it back for 10 cents when it was trading at 74.75 or whatever. Whew. Okay, anyway, sorry. That one worked out for me. Goose, not so much, but still a very profitable position and literally no risk. Now, to your question, what's happening here? Well, all these deltas are 1. Now, everything in the money, the delta is 1, which means essentially the gamma is going to go to 0 because they can't change, right? They can't adjust. Why is this going so high? All right. Well, the 75 call is slightly out of the money. It's really at the money. It has a delta of 0.47 or 0.5. Gamma is the rate of change of the delta if the stock moves up or down a point. What happens if, oh, I'm sorry, I'm on puts. I'm sorry, Fernando, I'm on puts here, but the stock is a 75.10. So the 75 put is just out of the money. I'm sorry, it has a 47 delta. It's just out of the money, 0.5 for the at the money. Okay, everything below it is 0, everything above it is 1. Why? Because that's what happens. The at the money's still at 0.5 until it decides where it ends. What do I mean by that? When the stock was at 74.80, this delta was at 0.9. And this gamma, if there's a 1-point movement up in the stock price, the gamma would have been really high because as soon as it crosses from 74 to 75 or goes above, 74.90 to 75.10, this now goes to 1. If it's a call, it goes to 0 if it's a put. So the gamma is extremely high because as soon as it moves deeper in the money by 20, 30, 40 cents or deeper out of the money by 20, 30, 40 cents, it's got 2 places to go, to 0 or to 1, because all the time value is gone, right? What happens at expiration? Guaranteed. All time value disappears the minute of expiration. All deltas are at 0 or 1. In theory, the at the money is still holding at 0.47, but all options that expire that day go to 0 or 1 because they're either in the money or out of the money. But that's why your gamma at the money increases, because any movement where it's toggling right around the price is going to force your delta to go closer to 0 or closer to 1 very, very, very quickly. And that's why the gamma is so high. So if there's probably a 30-cent move, if this was a snapshot at 3:50 p.m. Eastern Time, and Ollie dropped down to 74.40, this would have, as soon as it went down 20 cents to probably 74.60, this delta would have gone to 67, and the gamma would have gone up to 37 because the next movement down by 20, 30 cents is going to put it right at 1. Okay? Now, it's still considered at the money because these are 5-point strikes. Ollie doesn't offer single strikes, and it's easier to see that in single strikes. It's more of a curve. This is literally a peak. It's either 0 or 1, and you can even see here, yeah, it's got a 12 gamma here for the out of the money one. Delta's not going to go to 0.12 in the last 10 minutes on the 70 strike put that's deep out of the money because they're only 1 strike apart. All right. So that's why you see the gamma move so quickly on expiration, because the 2 things that are happening is time value goes to 0. Deltas are either going right to 1 or right to 0. And so this gamma of the at the money option has to compensate that if it's hanging right around 0.5, it could quickly drop below 0.5. Okay? I think you're overthinking it, Bill. Bill says another thing here in relation to what I was just talking about with the calls in that case. And he's referring to, he says, not quite what I was asking. What I mean is if I've sold a call at $1, and Bill, there's more to this that I might need to know later via email. If it's an out-of-the-money call, you're selling as a naked call, or if it's part of a spread, or if it's just a covered call, that's the real question. So if you said you sold a call at $1 and it falls to 80 cents the next day, okay, so you gain 20 cents. If you roll it to take out the 20 credit, I'm just protecting myself against the stock going the other way and the price of the short rising higher than what I've sold it for. No, you're right. But again, what I was trying to illustrate is that you're in the process of developing a trading plan for the strategy you're using, Bill. And you're saying that you sold that call for $1, whether it was a naked call, whether it was a covered call, whether it was part of the diagonal, whether it was probably part of the diagonal, but it was part of the diagonal, okay? But you sold that call because the strategy you're using, the $1 premium you got, matched the return you wanted for your trading plan of what your goals are for week by week or month by month, what your win-loss ratio is, and what your management techniques usually perform. So your trading plan has, I wanted this premium because it gives me this return. My management makes sure I don't take more than this percent loss, and I've been right 78 to 80% of the time. And you run those numbers, and you see that you're profitable. Now, what I was trying to illustrate is that what you want to do is go back to radioactivetrading.com maybe this weekend. Click on the Resources tab and go down to the Trade Simulator tool. Think about what I just talked about. With the strategy you're referring to, when you get your dollar premium, what is your percent return? What is your average loss with your management techniques and trading plan? What is your win-loss ratio? And how does that work for you? Now, I know you won't do it every time. Say 30% of the time you close out this return that you wanted, this target return you wanted for a smaller premium. Does that really work in your favor where you're enhancing the other side and getting more upside because you closed the call early? Is the 20 cents, closing for only a 20-cent gain 33% of the time, if that lowers this down to 7% average return from premium generated, how does that affect it? Does that still keep you in the profitable zone? Is it increasing this probability of loss or lowering the probability of loss enough, or increasing maybe even the gains enough to make it profitable? So that idea, your idea is conservative, but I use that credit spread closing at 50 with 50% profit, closing it early if you have a 50% profit early, to illustrate the idea that, is it a good idea? It's conservative. Take some profit off the table. I agree with you. If I'm in a diagonal spread, I've sold the call for $1 on the weekly. On Monday it opens up and I can buy it back for 80 cents. I've taken 20 cents and I've left the upside open. Hey, that's conservative. But I didn't get the full dollar I originally expected. I didn't lower the cost of my long option by the full dollar I was hoping for to get the risk reward I originally evaluated. And now I have to ask myself, by closing these early, am I increasing or decreasing the targets over time? Am I increasing or decreasing my win-loss ratio over time? And how is that going to perform over time? So plug those numbers in and check it out. It is a conservative play to do that. It is a conservative play to close early. It's a conservative play to close the credit spreads early. My fear is that if you're closing those credit spreads too early, or you're closing your premium for too little of an expected profit of what you expected to make, you're affecting your win-loss ratio and your target return too much, where your new ratios are not profitable long-term. So play around with those numbers and let me know what you find, okay? It does alter it. Everyone says, oh, well, I bought this leap for $5 and I sold this call for $1, so I really only have $4 in the leap, and if the stock's trading right at the short-term strike price, I'll make a 20% return. But now I closed that short call for 80 cents. Well, I've only dropped the value of my long call down to $4.80, not $4, right? It's changed back. I've put that money back into the cost of that long option. Now, anything I sell against it is based on the cost basis of $4.80, not $4, because I didn't receive the full dollar return. That's the trade-off in that case. So that's what you want to take a look at and consider. So play around with it this weekend, Bill, and then as always, send me an email. Give me a call next week. Send me an email over the weekend. I'll try to take a look at it and talk about the numbers that you saw. And I'm going to try to get something together better for us to look at the spread idea of closing them early. All right. Now, I don't see any other questions. I think I've addressed everything that came in. I just want to remind everyone that, of course, today's material are just my thoughts on your questions and designed for educational purposes to increase investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading recommendations. Although Goose still looks good, Sam throws out his ideas, of course, and we appreciate that and what he's done over the week. He's still got some positions open in Twitter and looking at other things. And you know, Rajiv's position on Disney looked pretty good too, regardless if he rolls it or not, and the Pepsi position looks pretty good too. Remember, options do involve risk, may not be suitable for all investors. I'll get that corrected. Hey, the markets are going to be closed Wednesday, July 4th, but that's 2 weeks away, so we'll have another session there, and we'll still have a Friday session that week on July 6th also. Okay, all right. Kokon says, can you post to a web sooner? Well, I can try, but usually what happens is after this webinar ends, I've got to convert it. It converts automatically on the computer, and depending on the length of the webinar, it may take up to 2 hours to convert over to the format to upload. I can't promise that I'm going to be here on the computer at 8 o'clock tonight, 8:30, 9 o'clock. I can't promise that I'm going to be down here tomorrow morning either. I'll try to get it posted Saturday for you. I can't promise tonight, but I'll try to get it posted Saturday for you as I promised last week. All right. Remember, everyone, if you haven't done so yet, remember you can go to poweropt.com. Just put in your name and email address, and you'll get a free 14-day trial, no credit card required. After that, the subscription levels start at $40 per month. We also offer delayed, that's for the end-of-day service. There's also the 20-minute delayed. It's the most popular. It's only $60 per month. And we do offer the historical upgrade to that at $100 per month, and of course the real-time higher at $120 as well. Okay. All right. And then for other free information, remember you can check out the blog, blog.poweropt.com. And as mentioned, you can check out all of the archive webinars. We didn't look at that, but the archive webinars, you go to poweropt.com/webinars.asp, and you can check a look at all the archive presentations there. You can also check us out on YouTube to see any of our public ones as well. All right, and just remember, if you have any questions later on, please feel free to send an email to support@poweropt.com or support@radioactivetrading.com. Remember, you can also call us during office hours at 302-992-7971. And remember, trial and subscriber schedule a coaching session. As a question I can't answer, here's one that came in at the end. Rajiv says, is MU right for a covered call or bull put credit? I cannot answer that. Okay, that comes down to you. If you like the premiums, it could work. And if you like the premiums and you feel it's a bullish to neutral position, a covered call, a bull put, a calendar spread, more done in the way of buying an in-the-money call a few months out and selling it at or just out of the money, rather than buying it out of the money and selling it out of the money. But a diagonal spread, true diagonal spread with an in-the-money call would also be a good trade. I can't tell you if MU is better for a covered call or bull put, because that comes down to the risk tolerance, the monetary value you could risk in the worst case scenario if the stock suddenly falls out of bed, something happens geopolitically. That's something I can't answer, Rajiv. Both are strategies for neutral to bullish stocks. If you feel MU is a good neutral to bullish stock, those would be good strategies. But even with a stop loss, if something unexpected happens and the stock falls 30%, if you do a covered call, you're on a hook for that loss. Your stop loss gets violated. You're still going to have, let's say you generate 3%, you're still going to have a 30% loss. On the bull put, you'll lose 100% between the strike prices, but you have that locked in. You can't lose more than the difference in strike prices minus the net credit. You might also want to consider a standard collar as well. And a standard collar in that case means, you know, I'd buy the stock, sell the call, and of course buy an out of the money put. So I have something that looks like a spread, but my risk is only 4%. My upside is still 2.5%. And yes, Rajiv, there is a tool on Power Options you can check out. If you go to, you can just type in MU, and then you could go to Search Summary. Now, it doesn't compare this graphically, but you can link to the graphs later. But you can pick and choose. So I want to see bull put credit spreads and covered calls, for example. And, oh, did that really just do that? All right, let me go out to the 29th, for example. And this will show you some potential covered calls with the percent if unchanged, at or out or slightly in the money, and some potential bull put spreads, which I don't really like because they're all 50-cent strikes. It's just trying to grab the, oh, there's a 1 strike difference. So you can compare the monetary gain to the percentage return, maximum risk, and a break even. And then you can do further research using the more information buttons. But this is the search summary tool. You can just put in a symbol and click on search summary. I didn't switch over the screen, did I? There we go. Okay. So again, put in your symbol, MU, and then click on search summary. Then you can pick and choose which spreads you want to see. You could add long call in there. I could add calendar call if I wanted to. But then I got to suggest select the week. So let me go out just to the 29th. Okay, so now we've got the covered calls with the stock at 58.23. So we see some in the money covered calls, at slightly out of the money. We see a couple different bull put spreads here where the top 3 don't even, let me look. I got to look at this. Oh, those are the calendars. I'm sorry. These are the calendars. That makes perfect sense. These are the calendars. And then the out of the money bull put spread. So you can sort of compare the return to monetary risk, debit, and there monetarily, but then you can just link to the profit and loss chart very quickly. So that will get you to where you want to go. But take a look at a collar too, standard collar, and this will allow you to do the comparison there as well. Okay? All right, so that's the search summary tool. You can also access it under the signature tools tab on the main tool menu page. All right, everyone, take care. I hope you all had a profitable week. Sam had a really good week. Even with me sort of shortening the gain on Goose, I also had a fantastically profitable week. I hope yours was great as well. I hope to see everyone next week, and we have just as good of a week next week also. So everyone, take care. We'll see you soon. Good night.